In this first part, we delve into the intriguing world of options contracts, an underutilized yet powerful strategy to turn non-dividend paying stocks into a regular income source. You'll learn how to set up these contracts on popular trading platforms like Ameritrade, Webull, Robinhood, and Interactive Brokers. If you've ever felt frustrated about having favorite stocks that don't distribute dividends, get ready to discover how to generate a steady cash flow, monthly or quarterly, from these investments. I'll demystify every step of this surprisingly simple process, dispelling any doubts about its feasibility. Through an analogy involving buying a painting as an investment, we'll explore the logic behind someone offering to buy your asset at a higher price. This is the essence of options trading. You provide the opportunity for others to buy your investment at a predetermined price, hoping the market value rises. But as the seller, you benefit regardless of market fluctuations, ensuring profit both from the sale and the retention of the asset and the options premium. Understanding the dynamics between buyer and seller expectations in options trading is key, and I'll do so in a clear and straightforward manner. The beauty of this strategy lies in its flexibility and the opportunity for repetition. Month after month, you can write new options contracts, paving the way for continuous passive income from your investments. First, we will unravel the nuances of options contracts. I'll guide you step by step through the process, showcasing how to transform your non-dividend paying stocks into lucrative assets. You'll learn to identify the right stocks in your portfolio that are ripe for this strategy and understand the critical factors to consider before writing an options contract. Next, we delve into real-world scenarios. Using practical, everyday examples, I'll demonstrate how options contracts work in various market conditions. You'll see how different stock profiles can benefit from this approach and how to tailor your strategy to fit your financial goals, whether it's generating monthly or quarterly returns. Understanding risk is crucial in options trading. This part of the video will provide a balanced view of the potential rewards and risks associated with options contracts. I'll share insights on market volatility, how it affects your options trading, and techniques to mitigate risks while maximizing returns. We'll explore scenarios where options trading is advantageous and situations where caution is advised. Furthermore, we'll cover advanced concepts like strike prices, expiration dates, and option premiums. By breaking down these concepts into simple, digestible terms, you'll gain a thorough understanding of how to leverage these variables to your advantage. The segment also includes real-life success stories and cautionary tales. Hearing from those who've navigated the options market successfully can offer invaluable lessons and inspiration. Conversely, understanding common pitfalls can help you avoid costly mistakes. Finally, we'll discuss the long-term impact of options trading on your financial journey. How does this strategy fit into your broader investment plan? How can it complement other investment approaches? These are some of the critical questions we'll answer. First, let's delve deeper into the concept of capped gains, the primary downside of options contracts. Using detailed examples, I'll illustrate how setting a selling price on your stocks through an options contract can potentially limit your earnings. Imagine your stock value skyrockets unexpectedly. While you secure a profit, you might miss out on even greater gains. This scenario is crucial to understand. While options provide a steady income, they may sometimes restrict the full potential of a stock's growth. We will also analyze the probability and impact of such scenarios. How often do stocks see such dramatic increases? And what are the chances that your options contract might cap your gains during such a surge? Understanding these odds is key to smart investing. Moreover, this segment will discuss how the duration of your options contract influences your risk exposure. Shorter contracts might seem safer, but they also mean more frequent decisions and potential missed opportunities. On the other hand, longer contracts might lock you into less favorable terms over an extended period. What's the sweet spot? We'll break down the factors to consider in deciding the duration of your options contract. Additionally, I'll provide insights into different types of stocks and how they perform in the context of options trading. Not all stocks are equally suited for options contracts, and understanding the characteristics of your stocks can help you decide whether this strategy aligns with your investment goals. Importantly, we'll cover strategies to mitigate the feeling of regret or missing out. While it's natural to feel disappointed when realizing a stock's value soared beyond your contract's selling price, remember, investment is about calculated risk and long-term strategy, not just individual wins or losses. Finally, I'll share practical advice on setting realistic expectations and aligning your options trading with your broader financial goals. Remember, options contracts are just one tool in your investment arsenal. They should be used judiciously and in harmony with your overall investment philosophy. As an investor, you have the flexibility to set the length of your options contract. This could range from a month to over a year. The key here is to understand that the duration of the contract directly impacts the options premium you receive. Longer contracts generally yield higher premiums due to the extended opportunity for stock value fluctuation. I'll guide you through examples to illustrate this concept and help you assess the ideal contract length based on your investment strategy. Next, we focus on setting the strike price of the contract. This is the price at which you're willing to sell your stock. Your choice here should align with your investment goals and expectations for the stock's performance. If your strike price is close to the stock's current price, the premium will be higher, as the probability of the stock reaching this price within the contract's term is more likely. Conversely, a higher strike price might attract a lower premium due to the lower likelihood of being reached. Through practical examples, I'll demonstrate how to strategically set your strike price to optimize your earnings. Throughout this section, I'll also delve into the relationship between the strike price, contract duration, and the premium you can expect. We will analyze various scenarios to help you make informed decisions that align with your investment objectives. Moreover, I will provide insights into market trends and how they might influence your decisions on options contracts. Understanding market dynamics is crucial in determining both the duration and strike price of your options contract. Finally, I'll share tips on continuously evaluating and adjusting your options strategy. The stock market is dynamic, and your approach to options trading should be adaptable. Regular reassessment of your contracts based on market changes and your financial goals is essential for long-term success. In this insightful segment, we focus on transforming your favorite non-dividend stocks into sources of regular income through the strategic use of options contracts. The concept is straightforward. Suppose you've invested in a stock at $10. You can set up an options contract choosing how long it should last, from a month to over a year, and at what price, the strike price, you're willing to sell your stock. This might be slightly above your purchase price, say $15. In doing so, you're essentially offering someone the right to buy your stock at this predetermined price within a specified time frame. Here's where it gets interesting. For granting this option, you receive an upfront payment known as the options premium. The premium amount varies depending on the length of the contract and the proximity of the strike price to the current stock price. The closer the strike price to the stock's current value, the higher the premium you can command. So, what are the outcomes? If the stock price doesn't reach the strike price within the contract period, you keep the premium and your stock. If the stock price surpasses the strike price and the option is exercised, you sell at a profit, in our example, $5 per share, plus keep the premium. This way, you're creating an opportunity to earn from stocks that otherwise wouldn't provide regular income. The downside? Your potential stock gains are capped during the contract. If the stock price skyrockets well beyond your strike price, you miss out on those additional gains. But remember, you haven't lost money. You've just limited your upside for the contract duration. This strategy, known as writing covered calls, is an excellent way to extract regular income from your stock investments, particularly for stocks that don't offer dividends. It's about finding a balance between earning steady income and capping potential gains. In this fascinating section, we explore how to supercharge your passive income by combining dividend stocks with option strategies. Imagine owning a dividend-paying stock that not only provides regular dividend income but also generates additional income through covered calls. This approach is akin to putting your dividend stocks on steroids, turbocharging your passive earnings. Here's the intriguing part. Stocks that are relatively stable, with minimal price fluctuations, tend to offer lower premiums on covered calls. Why? Because the perceived risk is lower. Conversely, stocks with more volatile price movements can offer much higher premiums due to the increased risk and potential for significant price changes. This creates an opportunity for savvy investors to earn more from stocks with higher volatility. However, this strategy isn't without its considerations. For instance, while high premium stocks can boost your income, they also come with higher risk. It's a trade-off between potential income and market stability. My personal approach, which I share for informational purposes, involves setting my strike prices a bit higher than the purchase price. This way, I don't significantly limit my upside potential. If I buy a stock at $10, I might set my covered call strike price around $13 to $15, depending on the contract duration. This strategy is about balancing risk and reward. It's crucial to find a sweet spot that aligns with your investment goals and risk tolerance. Whether you choose to apply this to more stable stocks for lower risk or more volatile ones for potentially higher returns, the key is understanding the trade-offs involved. I hope this insight has been educational and adds a powerful tool to your investment arsenal. If you found this video helpful and want to boost your passive income through intelligent investing strategies, don't forget to subscribe. Thank you for your support, and I wish you success in your financial journey.